What is going on, guys? Nick here, back with another video. Peloton's earnings just dropped last week, and there's a lot of chaos going on with the company. But somehow the stock has still seen a pretty good bump over the past week, so let's take a look at what's happened. So leading up to earnings, Peloton's had a pretty rough few weeks. First, on January 20th, the company announced they were going to halt production of its bikes and treadmills as demand had fallen. I think most people probably have a pretty good idea of what's going on and why there's been a big drop in demand, so I'm going to make this brief, but basically in 2020, when everybody had to spend more time at home, there was obviously a surge in purchasing new at-home products. And since you couldn't go out and stuff your face eating brunch, why not get in shape? Well, Peloton became one of the hot stay-at-home products, and orders went through the roof. But as the world started to return to normal, Peloton had made a huge mistake. Peloton basically overestimated how many products it was going to sell in the post-COVID era. And now they have thousands of bikes and treadmills sitting around warehouses that they still need to sell. And adding even more insult to injury, according to CNBC, Peloton's upcoming strength training product called Project Tiger has seen lower interest from customers than Peloton was expecting, which basically just means that demand has really fallen right now and there's no signs of a bottom yet. Peloton also announced that their CEO John Foley will step down from the company, and former Netflix and Spotify CFO Barry McCarthy is going to take over. But the company still needs to make major changes if it's going to remain viable. So Peloton's strategy is to start off with cutting costs and reducing some of its spending. Now on February 8th, Peloton released its earnings. They announced a loss of $1.39 per share versus a loss of $1.18 expected, and revenue came in just slightly lower at $1.14 billion versus $1.13 billion expected. Their guidance for the full 2022 year came in expecting $3.7 billion to $3.8 billion, which is down from the previous $4.4 billion to $4.8 billion. They also now expect 3 million subscribers instead of the 3.35 to 3.45 million expected by the end of the year. On top of the poor earnings, some pretty negative headlines came out about the internal management within the company. The company had to lay off 2,800 employees, and as part of their severance package, they gave out one-year memberships to Peloton. A lot of people are very angry about the layoffs, and for a lot of them who may be struggling to pay their bills, a Peloton membership just really doesn't help and comes across as a little tone deaf. Well, some of those 2,800 employees crashed the new CEO's first all-hands meeting, and they let Barry McCarthy know that a lot of them were struggling to get by, some of them having to sell all of their Peloton apparel just to pay their bills. While the meeting was apparently cut short, it does speak to a lot of the chaos internally within the company. I really think it's going to be tough for them to get things back on track with all of this internal turmoil. I really couldn't imagine that they intended to allow the fired employees into this meeting. Plus, even for the employees who didn't get fired, I'm sure quite a few of them have some harsh feelings about seeing some of their friends laid off. The whole situation just seems like a total mess right now. So when we look at this quarter in red, compared with a full year of earnings reported by each quarter, we can see that this was a pretty substantial loss. At the beginning of 2020, during the surge in demand, they started to turn a profit for a few quarters, but still, all of that investment spending on increasing production seems like it drove them back to showing a loss. When we look at all of their revenue and net income, things look a little worse. The loss we've seen over the past year's earnings has grown by a lot, which to me sounds like they've already spent a lot of the excess cash they gained from the additional sales in 2020. When we look at their revenue versus expenses, we can see that even though by the end of the 2021 fiscal year and the past year they earned the same amount of revenue, all of their costs have increased by a good amount. The biggest increase comes from their sales and marketing, which went from 18% of the revenue to almost 26% in just 2 quarters. When we look at their segments, keep in mind that this is just gross profit, so the revenue generated by each segment minus the cost to produce that product. Well, we can see that connected fitness products, while they recorded a slight drop in revenue, the loss in gross profit was actually way larger. However, I do want to point out that their subscriptions have continued to increase. Now, when we look at their current forecasted earnings, we can see that Peloton is currently projected to record a pretty big loss this year in 2022, but the expectation is for sales to rebound by 2023 and get closer to profitability by 2024. When we look at the revenue growth, the current forecasts seem pretty modest at just 11 and 18% growth by 2024. On one hand, I think Peloton has a great product and great branding associated with it, so while they're experiencing some issues managing the business and dealing with excess inventory, this doesn't quite seem like a death sentence for the company. I think to value them, I am going to price in some uncertainty because there is a lot of turmoil internally, and I'm just not entirely sold on how much demand is still going to rebound. Still, since I typically use forecasts, I will stick with that for now. So I think a growth rate of 10 to 15% seems about right for Peloton. And since they aren't profitable yet, we have to use a price to sales ratio to value them. I think about a 10% profit margin seems about right. They have a fairly high cost of revenue, which will will make them a fairly low margin business. And growth isn't extremely fast, but I do think that the subscriptions business will add a lot to their bottom line. A growth rate of 10% with a profit margin of 10% gives us a price to sales ratio of 2.1, and a growth rate of 15% and a 10% profit margin gives us a price to sales ratio of 3.3. So when we look at this valuation charted out, and keep in mind that this is a fairly conservative valuation, I would say that the current price of around 37 per share seems fairly valued for Peloton. The company sold off pretty far over the past year, so I know a lot may have expected to see this as a very cheap stock, but keep in mind that this does depend on a forecasted growth of 11 and 18% occurring over the next few years. So if the company overperforms earnings over the next few years, the stock will be worth much more than this. So I could see Peloton as a stock with a pretty decent upside, but still I'm avoiding it because right now I just think there's too much of a mess going on where I just rather see how management sorts these things out before I'd be interested in buying. Now I know there's one last question that people have been asking: what if Peloton is a good candidate for a bigger company like Apple to buy them out? But just from my perspective, this isn't a great investment strategy when no companies have actually shown an interest. There seem to be way more rumors that never actually amount to anything happening about Apple or another big company buying some smaller growth company. The reality is, when these things do happen, usually it's suddenly and completely out of nowhere, like Microsoft buying Activision for $70 billion. Now before you go, make sure you check out this great video I have over here for you next, and as always, thanks for watching.